Hello, welcome to Hollenbeck Unleashed in association with Dukascopy TV. Today's topic will be the improving economic conditions in the United States. President Obama and Fed Chairman Janet Yellen have been crowing about improving economic conditions in the USA. Unemployment is down to 5.7% and growth in 2014 hit 2.4%. Journalists and economists point to this improvement as proof that quantitative easing was effective. They seem to have political blinders on. The boom is artificial and is built by adding debt on top of excessive debt. Total household debt increased 2.5% in 2014, the highest level since 2010. Mortgage loans increased 1.5%, student loans 6.6%, while auto loans increased a hefty 9.6%. The improving auto sales are based on a bubble of subprime borrowers. Auto sales have been brisk because of a surge in loans to individuals with credit scores below 640. Auto loans to individuals with strong credit scores above 720 have barely budged. Subprime consumer lending actually increased $189 billion in the first 11 months of 2014. Excluding home mortgages, this accounted for 41% of consumer lending. This is exactly the same type of lending that got us into trouble less than 10 years ago. This can only really end in tears. Is the current improvement in the U.S. broad-based? Are we seeing a sharp increase in productivity and real wage growth? Productivity has barely budged since 2010, and real wages have flatlined or declined for decades. For example, between 2007 and 2014, individuals who have only a high school diploma saw their real wages drop 4.9%. Those who have a college education saw their real wages drop by 2.5%, and those with advanced degrees saw a drop of 0.2%. Are we seeing a broad increase in investment in plant and equipment? And the answer is no. Today, in the United States, the average age of plant and equipment is actually the oldest on record. It is now clear that the shale boom was an illusion of prosperity. The same is true about improvements in housing. Following the financial crisis of 2008, real estate prices should have dropped much more than they did relative to other prices. Housing should then have remained in a slump, possibly for a decade or more, until the overhang of construction in residential and commercial real estate had been cleared off. The new ratio of relative prices would have allowed resources to move into the production of goods and services more in line with what society would demand in a functioning market. Today, housing is back with price increases at bubble era levels and construction activity is picking up. The improvement is being driven by professional investors stretching for yield in the buy-to-rent market and by historically low long-term mortgage rates of below 4%. Yet the overhang from the previous boom has not disappeared. It has just been left in limbo because of the extend and pretend strategy of banks made possible by the central bank's massive printing over the last 6 years. The number of vacant units in the U.S. still stands at over 18 million units, a level reached back in 2008-2009. The number of units held off the market is still at a record level of over 7 million units. Of course, when market forces return interest rates to more normal levels, the adjustment in housing will be even more disastrous. As Austrians have always warned, don't be fooled by the euphoria of a boom built on a mountain of malinvestments. A sustainable boom can only be built on a foundation of sound money. Any other is destined for a bust. Our current economic policies seem to be geared to create a never-ending series of booms and busts. We must find a way to get off this merry-go-round. The economic policies followed in the last 6 years can only be described as delusional. The problem in 2008 is that we had too much debt. And the solution, according to the geniuses in the Eccles building, was to reduce interest rates to boost aggregate demand by inducing households and businesses to take on more debt. In other words, you just had a heart attack because you're obese, and your doctor tells you that you need to eat even more by loading up on different types of debt, or I should say foods. We don't need a central bank to boost aggregate demand. This faulty, widespread educational indoctrination about aggregate demand is actually the poison eating at the heart of macroeconomic theory. It is not a lack of demand that is hampering growth, but it is a misalignment between supply and demand. Once you understand this fundamental economic reality, then no amount of printing will solve this problem. Printing money cannot correct a misalignment created by government incessant interference with the working of the price system. This printing, however, will actually make things worse, since it alters relative and absolute prices, causing a greater divergence between what society wants to be produced and what is produced. Interfering with interest rates is by far the most damaging policy imaginable, since interest rates are the price of time preferences and play a crucial role in aligning output with demand across time. The greater the misalignment across time, the greater the adjustment. It is too late to avoid the necessary reset, and the coming adjustment will be horrendous. Yet, have we learned anything? Will we repeat the same policy mistakes of the 1920s or of the dot-com and housing bubbles? When will we realize that we must shut down the definition of evil, which is a central bank, and its fraudulent sidekick, fractional reserve banking? How many times will we continue this rinse and repeat of booms and busts? Thank you for watching Hollenbeck Unleashed in association with Dukascopy TV. Next week, we'll talk about another hot topic in the financial press.